Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. This is session 3 of 4, and what we're doing in these sessions is reviewing different aspects of investing and what has happened during the last 13 trading sessions since we peaked in the market on February 19th at 33.8615, and that's what you're looking at here. And again, this is a 1-month chart where each candlestick represents 1 day in the S&P 500. And so we peaked at 33.8615 on the S&P 500 on Wednesday, February 19th. And of course, we had a negative reversal on the 20th, finished at the lows on Friday the 21st. And then we know that we had a lot of damage the next week in the S&P 500. And we bounced up this last week and on a relative basis had a decent week. But what we want to do in this session is we're going to be reviewing the underlying sectors of the S&P 500. So we're going to be lifting up the hood of the S&P 500 and really taking a look at what has happened over the last 13 trading sessions. It's hard to believe it's only been 13 trading sessions since we were at an all-time high in the S&P 500. But what I want to do is share with you what has really happened so we really understand what's going on under the hood of the S&P 500. And for this analysis, we will be using stockcharts.com. I pay for this service, and I will leave a link to their site in the description box below this video. Now, to start off with, we're going to be using the ETFs that represent these spaces, okay? And you can see the ticker symbols up here. So the S&P 500 is the SPY, which is the ETF that I use in this space. It's the largest ETF that tracks the S&P 500. And you can see here that since February 19th, so again, we're looking at the 19th of February 2020 through the 6th of March 2020, represents 13 trading days. And you can see we're down 12.08% on the S&P 500 during that time frame. Okay, and moving over here left to right, and by the way, guys, since I didn't say it, and I apologize, session 1, I would encourage you to look at all of these sessions, but however you found these videos, make sure you go through all 4 sessions because they're fascinating. All right, the first one we talked about equities and what's worked, global equities, what has worked and what hasn't during the same time frame, and correlations and how diversification has or hasn't helped you. On session 2, we just looked at the S&P 500 versus gold and gold miners versus high-quality government bonds. Session 3, of course, we're going through the sectors of the S&P 500. And then in session 4, we're going to talk about where we possibly will go from here, given the amount of uncertainty in the global marketplace right now surrounding the coronavirus and how this might impact for weeks or months to come, how it might impact the stock market. Okay, so I would encourage you, if you haven't seen the other two, the first 2 sessions, go watch those, and of course watch the 4th session as well. So again, we know we're down 12.08% on the S&P 500 over the last 13 trading sessions. The materials sector, which is the XLB, again, you can see the tickers up here, XLB, that's the ETF in this space, is down 11.55%, so fairly similar to the S&P 500 itself. And then when we get into communication services, companies like Facebook are in there. That ETF is down 13.48%. Again, the ETF representing the communication services sector, down 13.48%. Now look at energy, guys, down 22.52%. This sector has been dead money for years and years. And so I would be very careful if you're doing individual sector investing, trying to bottom fish and catch the energy sector because it's cheap, right? And a couple of weeks ago, I saw on CNBC, there was a billionaire. The guy's a billionaire, and he was talking about how cheap these energy stocks are. And that was before this downturn. So these things have gotten a whole lot cheaper since then, right? So trying to bottom fish, it just... I mean, if that's the investing you like to do, more power to you there. But man, that type of stuff scares me. I mean, things can continue to get cheaper and cheaper and cheaper. Just because something is cheap relative to where it's been doesn't mean it's a good value. Okay. So again, the energy sector, the XLE, is down 22.52% in the last 13 trading sessions. Ouch. The financial services sector down 17.92%. That's the XLF, that's F as in Frank. So XLF is the ticker symbol for the financial services sector within the S&P 500, down 17.92% over the last 13 trading sessions. The industrials down 13.88. That's the XLI, and that's I as in indigo. XLI down 13.88. We have the technology sector. Even though technology has done extremely well, over the last 10 years, it's still down 13.5% over the last 13 trading sessions. So a lot of big tech stocks in there. Great, and it represents, by the way, the XLK represents the largest component of the S&P 500. So in my way of thinking, the XLK, which again is the technology sector, XLK up here, the XLK represents, I believe, the most important sector in the S&P 500. So we definitely want to keep an eye on this. So on a relative basis, it's done extremely well, but it has pulled back 13.5% over the last 13 trading sessions. Now, the next three sectors, staples, real estate, and utilities, represent the most interest rate sensitive sectors of the S&P 500. Now, there's a reason I want you to understand that as we go into the review of these next three sectors, okay? Because for a couple of reasons. They tend to not pull back as much during this type of a downturn. They tend to be more defensive sectors, as well as the healthcare, which we'll get to, the XLV, the healthcare. But consumer staples, right? This is boring stuff, toilet paper, paper towels, things like that. That's the XLP, P as in Paul, okay? The XLP, again, the ETF is right there. That's down 4.57%, so about a third, less than half anyway, of what the overall S&P 500 is down over the last 13 trading sessions. Again, these have a tendency to be more conservative, more defensive sectors. They pay dividends. They're interest rate sensitive. And remember, the U.S. Federal Reserve came out last week and did a 50 basis point, that's 0.5%, cut on the Fed funds rate, right? So when that happens, these interest rate sensitive sectors have a tendency to they're helped with that type of a Fed rate cut. They generally will react positively, and they did this last week. So they had on a relative basis, much better performance than most of the other sectors in the S&P 500. So just keep in mind that consumer staples, real estate, utilities, if somebody has to stay invested, for whatever reason, they have to have equity exposure during downturns, these three sectors, and maybe add healthcare to it, but definitely these three sectors, consumer staples, real estate, and utilities, generally are your most defensive sectors. They're most interest rate sensitive. So if interest rates go up, they get hurt. If interest rates go down, like they did last week with the Fed funds cut, these three sectors tend to do pretty well. So consumer staples down 4.57%. During the last 13 trading sessions, the real estate sector down 6.67%. Again, you can see that everything's down, but on a relative basis, right? These things are down about half, or roughly half, or sometimes in some cases a little bit less than half what the SPY is, which is down 12.08%. So again, real estate down 667, and then we have the utilities sector, the XLU, which is down 442. And again, the real estate sector is a 4-digit ticker. It's XLRE. Okay, so all of these start with XL, and then you just have the B, the C, the E, the F, right, going down here. But the real estate, XLRE, RE for real estate. The utilities is XLU for utilities. And now let's move on to the XLV, which is healthcare. And for numerous reasons, this one did better on a relative basis than others last week. But the healthcare sector also tends to be somewhat defensive over most time periods. So the XLV is that's V as in Victor. That's the ticker for that one. It's down 662 over the last 13 trading sessions. And then you get the discretionaries, which, just think about the word discretionary. We don't have to buy these things, but we do buy them. There's a lot of retail in there. Amazon makes up, at last I looked, it's over 20% of that whole sector is Amazon by itself, right? So you've got the XLY, which is the ticker for consumer discretionary. The discretionary sector is down 13.32% during the last 13 trading sessions. So it's been hit fairly hard, but retail is under pressure anyway because, the brick and mortar retailers are being hammered by online shopping. And that's a mega trend, right, that is still playing out and has been playing out for several decades now. So, I think there's probably going to continue to be volatility in that discretionary sector. But keep in mind that 70% roughly of the economy around the globe is consumer spending. So if consumers are not spending, either through fear, right, the fear of the unknown, which is really what we're dealing with with the coronavirus and this recent downturn, and we'll get into more of this in the next session. But if people are not spending, they're not going out and spending money, that's definitely going to hurt the retailers. That is why the consumer discretionary sector, the XLY, is down 13.32% in the last 13 trading sessions. So I hope this has helped to kind of get an under the hood view, so to speak, of what is going on inside of the S&P 500. But as you can see, they're all down. It's just a matter of, what is down the most. And this is not to, I'm not trying to get you to invest in any one sector or combination of sectors. I'm trying to educate you on what happens in these downturns so that you understand underneath the hood of the S&P 500, or if you are curious about sectors and how they work and what the ticker symbols are. So hopefully this has helped on a lot of levels. But also I would encourage you not to try to bottom fish. That can inflict a whole lot of pain in a short period of time. The energy sector has been the worst performing sector for years in the S&P 500, and it continues to underperform. So people that kept buying this thing are trying to bottom fish and saying that energy is going to get better. They haven't made any money. And again, I would encourage you to go out and look at a 5-year plus chart of the energy sector, the XLE, and you'll see what I'm talking about. It just keeps going down and down and down and down and down. So trying to chase stuff down and buy it just because it's cheap, guys, I would encourage you to rethink that strategy. Okay? So thank you for joining me on this session, and I will see you in session 4.